The information featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether or not your decision is appropriate for you. Property Investing Matters is brought to you by Destiny, empowering investors to achieve success through property investment for more than 24 years.
Hello and welcome to Property Investing Matters. Thanks for tuning in for your regular dose of property investing education, where it's your chance to get some of the best property guidance from Australia's most well-known property experts. And don't forget that you can join into the show by asking us a question. And when you do so, you win the book prize. Now this week up for grabs is investing in the right property now. This is perfect for the very interesting markets that we have right at the moment. Now just email your question to pam@mypropertytv.com.au, or you can also send it to me in a direct message via my Facebook page, and then you'll be in the running for that prize. So let's get started on the show, and let me introduce this week's property expert, Damian Collins from Momentum Wealth. He is the MD of Momentum Wealth and also chair of Westbridge Funds Management. He served on the REWA Council since 2011, and he was elected president of the Institute in 2018. Now, Damian has a Bachelor of Business from RMIT University in Melbourne and also a graduate diploma from Curtin University in Perth, as well as a graduate diploma in Applied Finance and Investment through FINSIA. He is a fellow of the Institute of Chartered Accountants in Australia and also a fellow of the Financial Services Institute of Australia. So plenty of qualifications and experience behind him. Let's welcome Damian to the show tonight. Welcome, Damian. Okay. So Damian, I was really pleased that you were coming on the show this week because, as we all know, we're seeing property move everywhere, but we're also seeing it move in Perth, which is great news for Perth people and for Perth investors. But before we get to our discussion about Perth property, this week I did want to talk about other forms of property related investing, because there could be times where maybe people are interested in property investing, but they don't have enough for a deposit for a house for themselves. Well, they might want to diversify into other kinds of investing in property, but maybe do it around, I guess, the bounds or sort of safety net, not complete safety net of doing it with others in some kind of a unit trust or a property trust. So I really wanted to start by just talking, first of all, about property trusts, and maybe you can explain to the viewers just what is a property trust.
Well, Margaret, they're typically run as unit trusts. So when we buy residential property, for the vast majority of us, we'll buy it in our own name, or we will buy it with our partners, life partners, sometimes friends, but where our name is on the title. Now, some people use perhaps discretionary family trusts. In those cases, they may be a bit more familiar with how a property not being in their own name works, but they still control it. But generally with a property trust, they're far more widely held in that it may be a much larger asset. There's something that's out of reach for an individual investor. Could be 10, 20 million, $100 million, and some of them are even multi-billion dollar funds. And so rather than your name being on the title, generally with a property trust, what happens is you own units in that trust. For example, the fund was, let's say, buying $100 million of assets, it may well raise 50 million in units at generally $1 each. And if you put in 50,000, you would own 50,000 of 50 million. So it doesn't sound like a lot, but you're entitled to the same returns as anybody else proportionately. And it's then professionally managed by another party. Obviously, they get paid fees to do that. You get your distributions or returns depending on the performance of those assets in that fund. And often they can be multiple assets as well. And if it all works out, particularly in the commercial space, you should get regular recurring income stream if you've got good quality assets. So I think it's something that people should consider, particularly if they're looking for income stream in commercial property. The yields are certainly a lot better than residential. They've got higher risks and higher returns, but something particularly for people looking for income stream in retirement. I think property trusts are the way to go, because generally good quality commercial assets are well out of the reach for individual investors.
Mm-hmm. And so, just to sort of make it clearer to people, generally a property trust will buy some form of a commercial asset, and that could include, even a hotel with residential type rooms in it, or residential type apartments in it, depending on the trust. But without giving an actual lesson to everybody on managed funds, because it's not the managed fund show, it's the property show. Just briefly touch on what the difference would be between investing in a listed property trust and investing in an unlisted property trust.
Well, a listed one is one that's traded on the stock exchange, so you can see the value of every day, and it is they can be quite volatile. They can go up and down 30% or more depending on the state of the economy and a whole raft of other things, the state of the property market. Unlisted funds, the downside is they're not very liquid, but you don't have that volatility. Generally, they're based on the stock market volatility. Generally, they're worth what the fundamental underlying assets are worth. So there certainly are pros and cons of that. One of the things that people do need to understand is that if you invest in a property trust, an unlisted one in particular, you're governed by the terms of the trust deed. If you invest in these, generally you'll get an information memorandum or a product disclosure statement that'll tell you. And so your fund might be for 7 years, might be for longer. So you don't get to make the calls, make the decisions, particularly if you're a smaller investor. You're governed by the term of those particular documents. And most of the funds are 7 years, and often they continue to roll over. So just be aware of that it's if you've got your own residential property, you can go and sell it when you're ready. But if you're investing in these particular unlisted funds, listed funds, obviously there's a stock exchange market for them, but in unlisted funds, you are very much at the mercy of what happens with that fund, and not always easy to get out of.
And if I can just further dilute that for the readers, I know, when I first started delving into what managed funds meant and what listed and unlisted trusts meant, it was very confusing to me. So I've learned how to bring it down to the easiest concept to understand. And basically you're saying then that an unlisted trust, it's a fund that you're investing in, and you can only get your money back according to the terms of that fund. So you're directly investing in it, and if that fund is 7 years, after 7 years you get your money back, and along the way you might be paid dividends. And when you get your money back, it could be worth more or it could be worth less than what you put in. But when you invest in a listed trust, it's then listed on the stock exchange in the same way that a company share is. So in addition to the fact that initially it's priced according to its underlying assets, and the value generally stays around that, if there's a major stock market crash, feasibly your units could actually be worth less than what those underlying assets are if nobody's buying them, and if the value of that unit falls on the exchange.
Yeah, absolutely, and that's a really important point to note, that the stock market is quite volatile, and the assets do, in the long run, they tend to hover around the net tangible asset value of the underlying properties. But in the shorter to medium term, I've seen them go plus or minus 30%, depending on the fundamentals of the stock market. So it's got. Look, I think my philosophy on property is that residential is a great place to start, but it's not generally where you want to finish up, particularly if you're relying on those assets for income in retirement. We all know right now gross yields in Sydney and Melbourne are at an appallingly low, sub 3%. That's gross, not even net. Other places around the country can certainly do a lot better. But in commercial property, the yields in the funds can be 6, 7, 8% net return out to the investors. They've got a bit of gearing in the funds. So it certainly provides a better cash flow. I just think investors should certainly consider it. May not be for everybody, but if you're looking for income stream in retirement, certainly having a balance of commercial property could be something that people would want to consider. And given the size it costs to get into a decent sized commercial assets, for the vast majority of people, property trusts are probably the way they're going to get access to that asset class.
So that's just blown off a couple of my questions I was going to ask you about, what makes them good and why are they different. And if you're investing into a trust that is buying these commercial assets, obviously you're getting the opportunity to buy into things that you normally wouldn't. I mean, you wouldn't own a shopping centre generally on your own, but you can own a piece of that shopping centre by investing through a trust. What we do need to point out, though, Damien, to the viewers is that the big difference, I guess, in investing in a property trust and investing in a property somewhere is that because the bank can't take any security over that unit, then you have to have the cash to be able to do so, or put in place borrowing against an asset that you do have, like maybe your family home, in order to raise the funds to buy those trust units.
Yeah, absolutely. So you buy units in the fund. If you've got $100,000, you can only buy 100,000 units. You can't get funding from a bank to buy additional units. They don't lend against unlisted property trusts. I think important point there, Margaret, is most of the funds do carry gearing, generally around 50%, sometimes a bit higher, 55%, maybe even 60%. So just be cautious against double gearing, gearing against your home, and then buying into a fund which has got gearing. It all works well when the market's going fine, but should we see a property significant correction or crash in the commercial space, then you've got double gearing. So just be aware of that. Most investors tend to have it in their super fund. My experience in this is that people, particularly self-managed super fund, they've got to the age of 60, 70, maybe even in their 50s. They're looking for that income stream, and they use their superannuation money. It's I'd be certainly conscious and cautious of people double gearing against a home to gear into a fund. Yeah, if it works out well, you could do really well, but if it goes the other way, you might not get that money back. So just be very cautious about that.
Damien, just to make the differentiation as well, for anybody who has looked into these things, you can also invest in what's known as a property syndicate. How does a syndicate differ from a trust?
Well, a syndicate is generally a smaller scale operation, and it might be could be 5 to 15 people who get together and agree that with a group of friends, for example, they might go and buy a property. It could be residential as well, or it could be commercial. Everyone's generally in the syndicate. Everyone's name is generally on the title. So you will say, for example, if it was 10 people in equal shares, it might say your name is to 1/10 of the property. So often they are still governed by an agreement about how the property will be operated. I'd certainly even recommend, if it's just you and a group of friends, you'd always want to go and get something put together to talk about how it's going to be operated if somebody wants to sell and all those sorts of things. But generally they're for smaller scale properties and smaller number of investors. You can still appoint an external manager. But by and large today, apart from small, closely connected and closely held groups of people going on the title, most properties these days are done through, most investment, particularly with the third-party managers, done through a property trust.
Damien, if you are in a property trust and it is an unlisted trust and you're suffering from some financial, poor financial circumstances and some financial stress, is there any way to get your money out?
Generally, you'll find the fund do not have any redemption, and so the fund is for the term of the fund, and often they can be extended. Most funds will say after 7 years, if 75% of investors want to roll on, then at a vote, then it continues to roll on. So technically, no, you have no rights of redemption and no way to get your money out. Now, most fund managers will often have an investor database, and there may be investors who may be willing to look at your units, but there's certainly no. I wouldn't be relying on that. I think you've got to be committed to getting through to the term of that fund, and it's a long-term investment. There may be ways out, but look, certainly if something like the GFC happened, or a property market correction or crash, the chances of you getting out finding another investor would be pretty close to zero.
And I guess we do need to point out to the viewers that really the returns come in two ways. First of all, it is hoped that whatever you bought your unit at, when the time comes to divest from the fund, that unit is now worth more by mere virtue of the fact that the underlying asset, which is commercial property, is hoped to have gone up in value over that time. So your unit that you might have paid $1 for, hopefully at the end of the 7 years or whatever the predetermined term is, that unit's now worth $1.50 or $2, and you get back double your money. But along the way, you are paid dividends, which is income to you as your portion of the income that's made by the underlying assets.
Yeah, that's correct. So when you go into the fund, generally obviously the commercial properties get regular returns, and one of the good things about commercial properties is that by and large, depending on the lease terms, and some of the laws around retail shops, but by and large, tenants pay almost all the expenses of running that property. So the return in terms of rent should be relatively stable, as long as the tenant, of course, is stable. And most leases will have provisions in them for regular rent reviews. Often they are a fixed percentage per annum, could be 3%, could be 3.5%. And so each year, all things being equal, and the tenant is solid and stable, your return should be increasing each year. But of course, there is some variability risk to that. If interest rates go up and the fund's got debt, well, that could impact as well. So a lot of funds will pay distributions either monthly or quarterly. So it's a regular income stream. And unless we see significant changes in interest rates or the tenants go out of business, then that income stream should be pretty consistent. Certainly does pay generally a fair bit better than residential. Most of the net returns in the funds these days are to investors of 5.5% to 7.5%, depending on the asset and the risks underlying, and that's net out to the investors. So it's certainly a lot better than residential, but it does come with some additional risks, and people need to be aware of that as well.
Absolutely. Look, let's now turn our attention to the WA property market. And I really wanted to start today by talking about those vacancy rates, because over the years we have seen relatively high vacancy in comparison to many other capital cities. How they're tracking right at the moment?
Yeah, vacancy rates right across Western Australia are at or near record lows. We've just seen a significant underinvestment in housing over the last 5 or 6 years in particular, since the market in Perth turned down in 2015, and even most other parts of the state, the market turned down in 2011. So a long downturn. People weren't building very much, and all of a sudden we started to see, as the mining recovery started back in 2018 and particularly into 2019 and 2020, we saw a population start to increase again. We didn't see that exodus of people leaving the state. And of course, over the last 12 months, we've had a lot of returning expats, both internationally and from over east. So first thing they do when they come back to the state is rent. And we've seen people take up properties. Rents are up significantly. I was just talking to my property management head this morning, and she was saying that, yeah, she's doing rent increases $50 a week, and tenants aren't blinking, because in Perth, the vacancy rate reached a 40-year low in November, December 2020 of 0.8%. It's only marginally above that now at 1%, and I think it's going to be low for some time. We've got areas like Albany in the south east of the state, where its vacancy rates well below 1%. Across pretty much every major regional area, vacancy rates are 1% or low. So rents are rising significantly. I guess keeping everything in context, Perth rents were $450 a week in 2014. They dropped to $350 a week. They're back to about $430. So we're not quite back to where we were. And certainly even in Pilbara, where rents are now $600 or $700 a week, that's a long way off. Where they're a long way up from where they were 2 years ago, but it's a long way off where they were of $2,000 a week. So, but certainly for investors, it's good news. We have seen a lot of people take up the building grants that were splashed around the country in 2020. Some of that will be tenants who we know have gone and bought a block and are building a house. But the problem in WA is the mining sector sucked up a lot of labour, and a lot of the labour that was in the building industry left because we had a 5-year downturn where people couldn't hang around and wait that long. They said, well, I'm out of the industry, there's not enough work. So it's going to be a real challenge. The builders are having a very hard time delivering that work. And so while we'll see supply pick up next year, depending on what happens with international migration, I think we're going to be stuck with a very low vacancy rate for some time.
Yeah, look, and I guess one of the things about Perth for a long time is that because you technically have a reasonable amount of land supply still within a fair commuting distance to the CBD, particularly when compared to other capital cities, plus the fact that building was affordable and, all along has been relatively affordable to build a house, then for many people, but building that house was just as cost you about the same as renting, and if you could raise a deposit and being so affordable, the deposit wasn't so big to raise, then it was definitely worthwhile doing that building. But are you now saying that that's going to shift around now? We're not going to see as much building happening?
Well, no, I think we would like to see more. It's just that the labour supply is the challenge. Getting people to in the trade industries, you can't really get them from over on the east side of the country because they got their building grants to take up a lot of demand. And of course, international migration is pretty much turned off at the moment to get trade skills from over in Europe and elsewhere. So
we certainly can't send anyone over from here because you guys won't let us in. So
yeah, so it's not. That's the very popular Premier. He thinks he's on a winner there, and keeping that COVID-riddled, infested eastern status is his philosophy. And at the moment, it's very popular. Yeah, we're living in a non-lockdown environment, so I guess it's not going to change. Not going to change anytime soon.
I guess you'll end up being the last bastion on earth, the last COVID-free bastion on earth. But no one will come in and no one will go out, but you guys will be COVID-free. So that's very exciting. Moving on to values now. As a result of these higher rents, typically what happens is we see people who no longer want to pay the high rents, so they try harder to buy the property, and then we see property values going up. Are you finally seeing some movement in values as well?
We are definitely, Margaret. We've seen prices rise, according to the Bureau of Statistics, 15% in the last 12 months, and CoreLogic revising their figures, and I'm expecting a significant uplift in the Perth index to match around what the rest of the country has seen over the last year, which is getting close to 20-odd%. So we certainly have seen a significant uplift, again off a very low base. And as you mentioned, people are seeing that opportunity for their renting. They're on a $500,000 property, your rent's probably going to be in Perth, $450 a week or thereabouts. A mortgage on $500,000, depending on your deposit, might only be $200 a week. So the disparity is certainly very strong. We've seen first-time buyers a huge percentage of the market, well over 40%, and that's again driven by the affordable pricing, and people wanting to get into home ownership because it's a lot cheaper at the moment than it is to rent. We've seen upgraders in big numbers. Surprisingly, we haven't seen investors. Investors are still sub 20% of the market, which I think there's two reasons for that. I think the first is household balance sheet repair. Most people buy investment property based on the equity in their home. If you're in Sydney or Melbourne over the last decade, you've created a lot of equity, and so it's easier to buy an investment property. In Perth, when that growth hasn't been there, in WA, people don't have that equity as easily available. And it's also psychology. Numerous studies show that people's economic expectations are biased towards what happened most recently. And given the last 5 years of the downturn, right now we're seeing a lot of investors in Western Australia selling, and they've said, oh, look, I've had enough. I want to get out. And even though it's logically the worst time to be selling because the market's on the way up, unfortunately, people don't operate logically, operate on emotion. And so we're seeing that psychology. There's still not big numbers of investors, definitely better than it was 2 years ago, but they're about normally in the market cycle we're in at the moment, recovering market, strong economy, strong rental growth. You would expect investors to be close to 40%, but right now they're about half of that.
Okay. Look, final question before we go to our break. What has been the best performing parts of Perth?
Definitely the affluent areas have done particularly well. Cottesloe, which some of your viewers or many of your viewers might be aware of, is one of the more premium waterside areas. That's up about 25 to 30%. Certainly around the river and the coastal strip, they've done particularly well. Trig's up close to 30%. But even inland, along the Northern Corridor, along the railway line, the freeway, we're seeing particularly strong growth there. It's the areas that have still not really recovered in as big as the rest of the market. The rest of the market's up circa 20% on average. You will find that the new home subdivision areas are still, they're up at least, because a lot of those people got really hurt by the negative equity and the drops, but probably only up 10 to 12%, whereas most of the established areas where there's not a lot of new supply coming on are up 20%, in some cases even better.
Absolutely. Okay then, Damian, well, we do have to take a break in a moment, but for now, remember that if we are answering your question tonight, you will be the lucky recipient of one of my books. And this week, it is Investing in the Right Property Now, as I said before, perfect for this market. Just email your question to me at pim@mypropertytv.com.au. You can also put it in a Facebook post, pop it to me in Messenger, send it to me however you like, and when we answer it on the show, then the book's yours. It is time for us to take a break, but you can email out your message and your question to us while we're gone and still be in the running for that book. Stay tuned, we won't be gone long. Welcome back to Property Investing Matters on My Property TV, where you can catch free of charge content without needing subscriptions, and also watch our regular episodes of Property Investing Matters. I'm Margaret Lomas, and tonight Damian Collins from Momentum Wealth is helping me to answer your questions. And we're talking about alternative types of property investing and also the Perth property market, which finally is starting to move. And remember that you will receive my book, Investing in the Right Property Now, if we answer your viewer question on the show. So make sure you get them into me as quickly as you can via email or via Messenger. Damian, a couple of questions tonight, if you wouldn't mind helping me answer them. Let's go to the first one. It comes from Chris. And Chris says, "Hi, Margaret and team. My fiance and I watch your show every fortnight and we love it. I heard you'll be talking about the Perth market. My fiance and I are planning to buy another investment property in WA Perth by the end of the year. Our budget is between 300 and 350. What are the areas that you would recommend, noting cash flow is key? More generally, would you buy a house in Perth at the moment, given A, the inflated prices countrywide, and B, the fact that most jobs revolve around mining, which is an industry with an uncertain future, at least when it comes to coal? Last but not least, and having our budget in mind, would you rather buy in South Australia, Adelaide? And a lot of people seem to be fans of investing in South Australia. Thank you and look forward to the episode." I will point out that, Damian, that it's actually not my experience that people aren't fans of South Australia. I certainly know a lot of people who have been investing there, particularly lately. But what of the Perth market? What can you help Chris with?
Well, Chris, look, the markets all around the country have risen significantly over the last 12 months, and it's certainly a lot of that's due to the low interest rates. I mean, it's just so incredibly affordable at the moment. Look, Perth prices are sitting at median price in the low 500s. It's not even back to where it was in 2014. The Real Estate Institute of Australia does a study every quarter on affordability, and they show that in Western Australia, on average, 26% of your income in WA goes on a mortgage. In New South Wales, that's 44%. When you look at the rents, on average in Western Australia, 19% of the rents go on a median income goes on rent. In New South Wales and Tasmania, it's 30%. So you're starting off on a very affordable basis, and that's certainly a positive sign. Obviously, there is a fair bit of land supply still in the outer fringes. That will you certainly we won't get to Sydney prices or anything silly like that, like we did 14 or 15 years ago. But certainly, I think the upside to Perth in the current market relative to the other cities sitting in a median about 650. I think Brisbane and Perth should be around the 650 mark, and that's still about half of where Sydney is at 1.3. Both of those cities have got some room to grow. I guess in terms of your budget, 350, I would certainly be looking around the Rockingham area. We are, albeit in the long term, we are going to get the Kwinana port. It's going to move from Freo, so that's still a decade away. But I think that area down Kwinana, Rockingham has certainly been underappreciated, undervalued, and then certainly Kwinana and surrounding suburbs. You get a house for, believe it or not, the median price is still in the 200,000 range, 270, 280. So, and from a rental point of view, they'll get you 350 a week. So pretty good cash flow. I note your comments about the inflated prices nationally. Yeah, we'd all have liked to have bought 14, 15 months ago when it was perfect timing, right to the beginning of COVID. Well, but if you wait to buy exactly at the bottom and you wait till it comes around again, you might be missing out a lot of the upside. So I think it's still got some, as I mentioned there, got some good growth. Look, yeah, Perth and WA is very much a mining focused state. Although you mentioned coal, it is not a coal-based city. In fact, the only coal is really down in Collie, which provides the power supply. We don't export any coal. Very much Western Australia is largely based around iron ore, and secondly around gold, and then lots of other commodities, nickel, copper. So oil and gas, there's a big massive gas plant. So yes, it is a resource-based economy, but reasonably well diversified within the resources, except iron ore is certainly the biggest one, and heavily reliant on continued growth in China. So you mentioned South Australia. Look, I think South Australia, one of the someone once told me, and I think it goes true. South Australia, you're never going to get super rich, but you're never going to go broke. It's pretty much a steadier performer. Whereas in Perth, you could get potentially in WA, you could get super rich. You could also go broke. So it's a bit more volatile. So you've got to be in for and ride out the volatility. You won't see that volatility in places like South Australia. But then again, if you get Perth in the right time and getting in and maybe even getting out, your upside's a lot bigger.
Yeah. Look, I got into Perth at the right time just before the last boom, but I have been waiting a long time for any more from that, very patiently. Fortunately, I had bought in quite cheaply at a time when my property went up in value over 18 months to more than double. So it's been okay. It has sat there and hasn't given me any more since then, and it's on the rise again now. Chris, in terms of affordability, I agree with Damian, definitely down around the Rockingham area. But I think if you've got a long term as well, you said your fiance, I'm just going to make an assumption that you're both quite young. Over the very long term, you can't ignore the fact that up and around Yanchep, with forecast population growth being fairly high up there over the longer term, and lots happening, and very affordable properties that you can get right near the ocean, very good yields of between 5 and 6%, then you've got both that cash flow and the potential over the longer term to get growth. If you want some growth sooner, I do recommend Adelaide. We are seeing some really interesting things coming out of Adelaide at the moment, and while Adelaide tends to do 3.5% every year on year, so that over a 20-year period, it pretty close to compares to a Melbourne performance over a longer period. We are actually seeing prices move quickly. I have a property in South Australia, and in a year it has gone up by $70,000 off a base of only 320, from 320 to 390, and that's actually a 9 months difference in the two valuations. So we are suddenly seeing pockets of Adelaide do exceptionally well. Most of them exist either in those southern suburbs that are along the beach there, Christie's Beach, Port Noarlunga, very affordable. We're also seeing growth up around Monopara, and just those suburbs that are that little tiny bit north of the real trendy suburbs of Prospect, which are a little bit out of some people's reach. So I wouldn't be discounting Adelaide at all at the moment. I certainly wouldn't be discounting Perth either. I think both of those areas can give you a pretty good result if you're buying in the right places. Let's go to our next question. It comes from Sandra. And Sandra says, "Hi, Margaret. I'm still looking for my last property to buy in my portfolio, but prices keep rising in regional areas every week and are often bought sight unseen. Should I wait for the market to drop a bit, then buy? Unfortunately, with a limited cash budget plus cost and stamp duty, it's very disappointing." Which it is. And Damien, I don't know if you've been watching the regions over here, but the regions are doing very well too. Some say that's COVID. Some say that people will be over their tree change, like true city folk who have decided to move away from the COVID hotspots into the regions will get tired and bored and move back once COVID's under control. What do you think? Do you think that the regions will drop in prices or just stabilise a bit?
I think they're more likely to stabilise. I'm certainly reasonably bullish on those satellite cities that are within commuting distance of the major capital cities. Now, I think we're going to see a permanent change to the workforce, and while COVID's made us go home in a lot of states at the moment, when I've seen all the surveys, a lot of employees, and now it's obviously not practical for every job, but for those who have the capacity, a lot of employees want to work from home and have that work flexibility. And I think as we're in a, believe it or not, unemployment rate very low, that employers of choice are going to have to offer that workplace flexibility. Now, what does that mean? That also means that people can work remotely. I had meetings this morning with my team, all via Microsoft Teams. People use Zoom. You just don't have to be in the office like you needed to be. For so many years, it was just the done thing. You came in. So I really think that's going to open up a lot of those areas, that sort of extra 30 minutes out of town. So in your Melbourne context, I know Geelong has always been particularly strong. I think people commuting, if you're coming in from Ballarat, Geelong, these sort of regions, you're only coming in 2 days a week. It's again, not everybody works in the CBD, but it's certainly a lot more viable, and you can live those great lifestyles in much more affordable areas. In Perth, I think we're going to see areas like Mandurah that's got a great lifestyle. It's got had a really rough time over the last decade, but I think people are going to go, well, if I have to come up towards the city, not even necessarily all the way in the city, 2 days a week, 3 days a week, I can live that great lifestyle. Yanchep on the North Coast. So I think certainly I can't see, and when you get out to the regional areas, I'm not as bullish on those areas that are sort of 3 hours away. I just can't see how that, can't see a lot of jobs still. I think we still need a workplace and a workforce and a culture. I struggle to see that people are going to be able to live 3 hours away and commute a couple of days a week. Just don't think that's going to happen. So I think I'd be looking in those regional areas that have got a strong economy locally, but also have got some connection to our major capital cities that make them viable alternatives.
It's funny, Damien, when we decided 5 years ago as early adopters of the whole work from home principle to start doing everything digitally, including digital meetings with our clients and allowing our staff to have time at home as well. People all said, no, that's not going to work, And for us, when COVID hit, we didn't even have to do any pivoting because it was already how we were operating. I always knew that it would come to this. Admittedly, it's come much earlier than I thought. I thought more like a 10, 15-year window for people to start becoming, work from home workers more. But COVID brought it forward for us. and it's changing a lot of things about how people choose property, including what they want in a property when they choose. They want to be near good Wi-Fi or near good internet connections in the NBN. They want to have the kinds of homes that can have dedicated workspaces, not just, your kitchen bench. So the way people choose what they buy as well is changing. But Sandra, I agree with Damian. I think, the regions are all getting attention at the moment, but the sustainable ones will be the ones that are closer to those areas that offer the jobs. So your Geelongs and your Mornington Peninsulas in Melbourne, although the Mornington Peninsula has already gone up a little, but even the Cardinia Shire in Melbourne, very interesting old coal area where, Churchill and all the towns down there, Traralgon, everybody thought they would die when the coal industry went away from there, but now they've just become commutable to the city and commutable to those big centres around Monash and even Narrewarren and those areas where we've got lots of employment happening. And you can live in Cardinia, which formerly would have been thought to have been too far out of Melbourne to buy anywhere, but you can buy out there at an affordable price and get a fairly good rent return, and you'll find that there's more people renting or going out there to buy now, so there's a good impact. So if you look around those capital cities and go maybe up to an hour and a half out or 2 hours out, or even the big regions, I think that you're going to see that there's plenty of good stuff to come still. Next question comes from Cosmos, and he says, hi, Margaret. Thanks for the opportunity to ask a question. Buying an investment property through SMSF, what are the advantages? I'm not sure there's a lot of them, Damian.
No, I remember when the limited recourse borrowing first came in, where people could buy and leverage a property in a self-managed super fund, and I think a lot of people thought it was going to be the very hot, and lots of people going to use it. But the reality is that the lending has got complex. The rates weren't particularly competitive. I must say, certainly in my business, I don't think I've seen a self-managed super fund leverage buy for some time. They're just certainly it's quite restrictive. Look, if you've got a lot of cash. Perhaps you've got means in your fund and you want to buy an asset for cash. Maybe that makes sense. That from income is only taxed at 15% when you're in accumulation. If you go into pension phase, there is zero tax on on your income distributions, and capital gains also zero tax in pension phase, and in accumulation phase only 10%. So I guess putting aside the leverage, I think that's not so common anymore. If you've got a very significant self-managed super fund, you might look at some individual direct property, but the leverage side of it seems to have really died off.
Cosmos, I'll try and make this short and sweet. Everyone thought it was a great idea. The problem is most people only have 100,000 or 200,000 in their super fund, which means they can buy one property, even if they can get the money to buy it. Because the money is much higher than you can get in your own name now, then it means that the property yield has to be really good to cover its costs and still have something left over. On top of that, because it's separated from you, then the tax advantages, the 15% tax might be nice when the property is making a lot of money, but when it's not making a lot of money, it also means there's only 15% in deductions. So essentially, when you're buying in a super fund, those deductions, those on-paper deductions, only come at 15% instead of up to 45% in your own name. But that means the property has to perform even better again when you buy it in super than in your own name. Outside of all of that, you can't buy a property and use it yourself if you had that in mind, which some people did, because it's an arm's length asset. You can't do that. There's a whole lot of can't do's on it. It's very difficult to get the property in the first place in there, and the costs are high because the banks will want all sorts of legal advice around it, and they can be up to $5,000 for all the costs that you've got to have. Once you set up the custodial trust, which you have to also have, and all the advice and all the bank fees, then at the end of the day, it doesn't make a very smart investment for someone, and you'll only do it once, most likely. Most people don't have enough money in super to buy more than one property, and if they do, it might be two. But even then, it's two properties that you're not milking the best tax advantages out. You're not getting any tax advantages for yourself at a time that you might need to. I personally think that your super funds are far better vehicle for things like those managed funds and stuff like that. That's easy, liquid. You can put money in, you can take money out, you can put smaller amounts. You don't need to borrow to do so. You can still get into property, the kind of property Damian was talking about, through your fund. You can do it through a unit trust or a managed fund of some kind, and you're still going to reap those benefits, and it's going to be a lot better for you. I'm sure Damian would agree with that, Damian.
Yeah, absolutely. I just think it's such a concentrated part of your super fund. Most people, unless they've got millions of dollars, it's direct properties. Super is really not the place for it anymore.
And sorry, that was my phone. Normally it's off. No idea why it wasn't off today. And my kids are always complaining that my phone's never on. And the one time when it needs to be off, it's on. Let's go to our next question. It's from Lisa. Lisa says, "Hi team. Is now a good time to sell in WA? Or should we wait another 12 months for better growth? I'm scared of missing out on any market gains and losing more money. Value's not back to what I purchased 8 years ago." It is a tricky time, Damian, at the moment. If someone did buy just after the last boom, which is a little more than 8 years ago now, and then found that they lost a lot of value and they're probably not quite back there yet, now they're not trusting the market and are wondering whether the values are going to finally get back up. Should they sell now that they're close? I guess there's a little bit of, it's like the vaccination, isn't it? A bit wary about what the right thing is to do.
Yeah, unfortunately, I can see Lisa's suffering from a lot of investors, and that's the scarring of the downturn. It was the longest and deepest downturn in the REIWA's recorded history. So in the Perth property market, that goes back well over 40 years. So I can understand, Lisa, why you're scarred, and we are seeing that across the board at the moment, particularly amongst investors. People are saying, look, if I can get my money back or it's on the way up, I can sell, and I just want to get out of it. But I guess you try and put aside the last 8 years. I would say to Lisa, let's say you're looking at buying an investment property today. Would you buy the one that you're currently in? And first of all, you've got to take a view on Perth. So say, well, where is the Perth market sitting? Where's it likely to go? How affordable is it relative to other capital cities? What's the rental return I'm getting? Then what you would say is, well, the suburb and the property that I'm in, is that a good suburb for the long-term investment? And if all those, and is the property the right asset for that particular suburb that's going to rent well and be in high demand? If the answer to all of those three things to you is yes, well, then I wouldn't be selling unless you've got something else personally in your life you need to do with the money. And that's the trick as an investor. You've got to, we get scarred. It's I see people in shares go, well, I'll sell it when I get my money back, and often it keeps going down. You've got to take the emotion out of it, and I understand it's been a challenging period, but reassess fundamentally where the property sits today. Would you buy in Perth? Would you buy that particular property asset in that particular suburb? If the answer is yes, I would say stick with it and try and take the scars away emotionally and look at it as a new investment and reset it today. If the answer is no, it's not a good suburb, it's not a good property, well, then maybe you should think about selling it. But right now, I'm certainly feeling, given the global spending on infrastructure and getting the global economy out of all the COVID problems, certainly, yes, iron ore's been down a fair bit over the last couple of months, but it's still $100 a tonne, and it's costing most of the companies $15 to dig out. So it's pretty good profit margins, anyone's language. So I'm still fairly optimistic about where Perth can go. But as I said earlier in the conversation, you've got to be able to ride out the volatility and don't expect it to go up in a steady straight line.
Lisa, I don't know where your property is in Perth, but all of the research that we're doing there at the moment into many of the areas shows that there's still quite a bit of juice left in the tank. For now, I don't really see, it going down, not in the foreseeable future. I think it would be terrible for you after all of this time waiting to sell now and then find that a year later you could have got another $30,000, $40,000, $50,000, and then you really kick yourself. If you do decide to sell now, remember that you will bring out a capital loss, and that can carry forward forever and be written off against future capital gains. That isn't a reason to sell, but it can soften the blow a little bit of selling, but it does rely on you to buy another property and make a gain on that, or have another property already that makes a gain that you also sell. So there is that. But certainly, I've got property in Perth at the moment, and I did think about selling them dozens of times over the last 5 to 6 years, but I've hung in there because the yields have been pretty good, and you may have found that as well. So I think it's probably not quite the time to sell. Again, that depends on the suburb that you're in. I don't know where that is. So last question, and we'll try to make this a quick one, Damien, because it is a question that we could take forever to answer. Hi, Damian and Margaret. As I approach retirement, I'm thinking of liquidating all of my properties to invest in other more liquid assets. What would be the benefits and drawbacks? We need another show to explain all of them, but what are just briefly some very quick benefits and drawbacks?
Yeah, we could, Margaret. Look, I think firstly you're probably going to pay a lot of capital gains tax. That's one of the drawbacks. Certainly, perhaps in your lifestyle, if you're going to use retirement, you might be using some of your capital to draw down on. That may make sense to have some of it liquid. Without knowing all your circumstances, Ralph, I think maybe there's a happy medium there. If you've got some good quality residential assets, keep them on. They still won't give you the great yield. They might still give you net a couple of percent. And maybe look at putting some of your other assets in more liquid format so that you've got more ready access and availability to hopefully give you that great lifestyle you're looking forward to in retirement.
Ralph, I'd want to be looking at a couple of other things first as well. So what are your loans like? Can they be renegotiated into lower rates so that you free up some more cash flow? If they're P&I, can they be made into interest only to free up more cash flow? But just a couple of other things to think about is that, first of all, with property, when you retire, if you have some superannuation, maybe you can use that up first and use that to live on. And while you're doing that, hopefully if your properties are fairly solid assets, they'll be still growing. So your net worth at retirement at, say, 65, by the time you got to 75, you might have 10 years of super, or enough super to give you 10 good years. Then hopefully that net worth is worth more by then because your property portfolio has gone up in that time. So if the portfolio is looking after itself fairly well and it has a little bit of a cash flow, maybe use your superannuation up and then think about liquidating then. And at that time as well, you're well into retirement and your capital gains tax is going to be different. You can sell one each year and really minimize that capital gains tax. But the other thing is, depending on where you're sitting, if you want to keep investing in property, remember, property rents are the only form of investment income that a bank will accept for serviceability on a loan. So someone technically in retirement may find a lender who'll still give them more money, maybe to renovate, if you want to just increase your loans, or to buy more property, because they will take that rent as income, whereas they won't take share income or other income as income for serviceability. So that's a fairly compelling reason to me to hang on if you can. Well, that does bring us to the end of another episode of Property Investing Matters. Coming up on the next show, newcomer Todd Sloan joins me to talk about his new book, Australia's Home Buying Guide, and he's going to provide some great tips, especially for first home buyers. So it is a good one to catch up with. Now, if we answered your question tonight, you need to now send me an email to pim@mypropertytv.com.au. Make sure the subject line says book prize. Send me your name, address, and which question you asked, and your book will be on its way to you. Thanks, Damian, for your time today. It's always great to catch up.
My pleasure, Margaret. Good to see you.
Let's catch up in the new year so we can see just how things are going over there.
Look forward to it.
Be great. And it was great that Damian answered all your questions. If you want to catch up with Damian, he can be found at momentumwealth.com.au. Now you can email me at pam@mypropertytv.com.au. And on the screen now, you can see all of my social media contacts. Sometimes I'm on social media. Sometimes it all becomes too much for me and I'm not. So you might get something if you go on, or you might not. Don't forget to check out my free educational podcasts and vidcasts at destiny.com.au. And while you're there, sign up to the VIP to get the free monthly newsletter and also a weekly property news update. Have a wonderful week, and I will see you all back here soon. With any luck, back in the studio. I'll see you soon.
Property Investing Matters was brought to you by Destiny, empowering investors to achieve success through property investment for more than 24 years.
Hello there, I'm Margaret Lomas. You might remember me from my Sky News Business Property Show days. My company is Destiny, and we've taken the 25 years experience that we have in property advising and created Property Match. For the first time anywhere, now you can be matched with the investment property most suited to you. Give us a call today or visit the website mypropertymatch.com.au. Why not leave it to the people who know property investing the best? Destiny.
You can teach me your game with no reason.